take all of the gold in the world, it will be a cube that's about 67 feet on a side. And you could get a ladder and you could climb up on top of it and you could say, I'm sitting on top of the world. You could fondle it, you could polish it, you could do all these things with it, stare at it. But it isn't going to do anything.
Warren Buffett loves to make fun of people who invest in solid physical gold, and he's not subtle about it. Kevin O'Leary strongly disagrees with Buffett's harsh views on gold. Now you might be wondering, why is Kevin O'Leary worth listening to over the legendary Warren Buffett? Well, when you're a billionaire overlord, it's easy to forget about the concerns of ordinary Americans. And Kevin O'Leary, popularly known as Mr. Wonderful on Shark Tank, has much more experience dealing with ordinary Americans than Buffett. Even though Buffett is technically right, gold isn't a great investment. He's wrong about everything else. Gold actually solves a very important problem for ordinary Americans. Let's listen to what Kevin O'Leary has to say.
So what do you think about the gold mining stocks right now, and why maybe they're not performing in tandem with the price of gold?
Idiot management. The problem is the management of gold companies can't control their costs. I interview every gold CEO. Yeah. They come into the CBC or they come on the Lang O'Leary Exchange. I ask the same question to all of them. Look, give me one reason I should own your stock and not the gold you mine. Because I show them his chart, I show them the price of gold, and they are ugly. You'd rather own gold. Never own the miner, own the gold.
You think physical gold?
Yeah, well, here's what I do. I own physical gold for 50% of the position, so 2.5% weighting. And I use the GLDs, which are an American U.S. pay or U.S. Currency, product. And then I, supposedly own the physical gold that way. But what I like about the GLD is I can trim my weighting every month. So when it gets over 5% weighted, I ping off a few GLDs or I buy in the GLDs. Right. Physical gold, I go hug at night.
Right.
I think the thesis that many people are bringing to me now is, why not switch out of gold and the GLDs and buy the miners? They've had the living you-know-what pounded out of them. Yeah. They're at the lowest valuations vis-a-vis the commodity itself. Right. And I say they're going to go lower.
Wow.
I really do, because there is no reason to own if you look at almost everyone except the royalty ones, their costs keep going up in every case. I say they're mismanaged. I say if a manager can't control his costs, fire him, get somebody else who can. Because if your cost of mining the actual ounce keeps going up, why would I ever buy the stock? Give me one reason.
There's no mining CEO you like right now?
Oh, I love them all. I just would never buy their stocks. They're great people.
Right.
But you tell me one reason I should own the common. Give me one reason. Dividends are practically nil across the sector. You have huge operational risks. You've got idiot management on the juniors. Not that they're bad people. I'm just saying the cold, hard truth about investing. If you want exposure to gold, buy the gold. Forget the miners.
But do you think part of the problem is there's too many juniors on the scene, for example?
Oh, it's just a wasteland. It's carnage out there. We had the PDAC conference here. They were rolling in like ants into the CBC to get interviewed. I talked to all of them until the story got to be the same. Like it's the same story. Oh, woe is me. I can't raise any dough. My costs have gone too high. The mine is delayed 6 months. We're not in operations. After a while, it's just the same drone. It's boring. And I'm thinking to myself, these poor guys, their life must be hell. The definition of you're a bad person on earth is you go to hell and you run a gold mine.
Okay, Kevin, tell me, why do you like gold?
I like gold because, in a way, it's a stabilizer. It's an insurance policy. I listen to all the gold pundits, and they're always wrong as far as I'm concerned. It's possible to time the moves. I've owned gold for decades, and I simply have a 5% weighting.
So, as you can see, sophisticated investors view gold as an insurance policy against chaos. In fact, I'd be willing to bet Mr. Buffett secretly owns at least a few $1 million worth of solid gold himself. He just wouldn't tell us about it. But how does a rich investor like Kevin O'Leary decide when to buy or sell their gold? Let's take a look.
I look at it quarterly. When it becomes more than 5%, I sell into the strength. And when it weakens, I buy into the weakness. It's just a stabilizer. I'm not one of those guys that's going to go to 40% weighting in gold. Okay. I don't believe the hyperinflation story. It hasn't happened. Gold is popular for a whole host of reasons, and 5% seems to be enough. It's worked for me in portfolio management. It's the only security I own that doesn't pay a dividend.
Now here's the thing with gold. Some people think it's all about that to the moon moment, where gold hits $5,000 an ounce and they cash out with a truckload of cash. But Kevin's got it figured out. It's all about balance. 5% of your portfolio in gold isn't some wild bet on the future. It's smart diversification. It's like keeping a little bit of insurance just in case everything goes haywire. And honestly, in times like these, who wouldn't want a little peace of mind knowing your wealth isn't tied up in just stocks and bonds?
So, Kevin, I guess, do you not care if gold goes to $2,000 or $5,000 an ounce? You're still going to buy gold?
Yeah, I don't care. Like, let it run. I'll be selling into that strength, keeping it at 5% weighting. You know, what I've learned, I'm an old crusty investor. When everybody's saying you got to own it, you should be selling it. Because when it corrects, it doesn't touch the sides on the way down. So I simply say 5% is good for me. Some people like a 10, 15% weighting. I'm a 5% guy, and I'm disciplined about it. I hope it runs to 5,000. I don't care. I'll be selling all the way up, keeping it at 5%. And when it corrects back down to 2,000, I'll be buying it in. It's fun.
Here's where the wisdom really kicks in. Kevin isn't just riding the roller coaster of gold prices. He's playing it smart. When gold is on a tear and everyone's rushing in, that's when you start thinking about taking a little profit off the table. Gold has its ups and downs, but when you're disciplined like Kevin, you're never caught off guard. A 5% position keeps things safe, but still gives you room to benefit if gold goes up.
Finally, a large portion of our audience interested in gold. I know in the past we spoke about the mining stocks, and I know you like companies that pay a dividend, but it seems that the mining industry is warming up more and more to the dividend notion.
Sure, because that's where the capital is going. More and more investors are thinking the way I do. They want return of capital. My problem with miners is this, and I've felt this way for decades. I have a 5% weighting in gold. I use the GLD and physical bullion, which I store. I pay for the storage. And the value of the commodity is whatever the market price is every day. I don't have to have a manager in the middle screwing up his capital cost allowance, not controlling his costs. I say to them, look, you do what you have to do to get it out of the ground. I'm not going to invest in that. When it arrives, I'll buy it. And that served me very, very well over time because so many managers in the mining industry for the last 30 years have blown their brains out on cost. They are incredibly inefficient at mining the commodity.
Kevin is right. Mining stocks have been notoriously shaky. What you really want is the solid physical gold itself, not the paper shares of the gold mining company that become worthless if the company goes under. With physical gold, you don't have to worry about any middlemen messing with your returns. Sure, you don't get a dividend, but at least your gold's value doesn't depend on a CEO's whim or a random mining accident.
Investors who would choose the miners over gold would say, look, gold's not moving. It's almost like just having money there. Right. Whereas in the miners, it could be a really strong speculative play. You could really see your money.
But the history of miners is abysmal. Abysmal. The management is weak. They can't, I mean, they're constantly, being optimistic about their costs, and they always, give me an example of a great management team that's been consistent.
Randgold, Mark Bristow.
Yeah, but think about it this way. If I had bought the commodity 20 years ago, I'm probably better off than owning that stock.
Kevin O'Leary sticking to physical gold.
Yeah, I mean, it's the only asset I have that doesn't pay a dividend, but I use it to hedge against inflation. It's had a nice move in the last few weeks. It's interesting as a buffer. I keep it at a 5% weighting. I use the GLD to keep liquidity quarter to quarter. And I like to bring the bricks out and throw them on the table and say to my kids, you'll never own this unless you get a job. It's terrific. It's fun to look at.
It's not going to make you rich, and it probably won't beat the stock market over the long term. But you can be pretty confident that even 50 years from now, gold will still be a trusted store of value, giving you peace of mind when everything else feels uncertain. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, central bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. If you want to learn more about how gold can protect your retirement savings, I have a gift for you. Just click the link in the description to receive a completely free gold IRA guide.